Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields. Saw a new month-to-date low today on Friday. However, we're unable to hold it and kind of crept back higher, back into the range to kind of settle very close to unchanged on the week. So while we did see trending lower yields this week, we were not unable to hold on to the extreme. So we're kind of back up into the range. It seems to me right now it's going to become a week by week kind of trade where we're waiting for news. Next week we don't get a whole lot, but we do get some key dues and some key meetings coming up over the next month or so. That is what the bond market's going to be looking at, because as we heard from Chair Yellen this week, it could be low for longer as far as rates go. However, they could address the balance sheet, how aggressive they are in how they take hold of some of the rolling off some of the coupons, or whether or not they're gonna talk now and maybe do some action later is yet to be seen. So, but I think that the moves that we've seen from the late June lows, we saw the spikes up close to 240, and this week we got down below 230. So it's been a very busy time and a volatile time, despite the fact that implied volatility has not seen a massive trade. And if you look at volatility, it ended the week lower after Yellen spoke, after weaker CPI, after weaker retail sales, ahead of key earnings, and ahead of ECB next week. And so there's a lot going on in the market. Big moves, small moves, it doesn't matter. Volatility doesn't seem to be affected. If you look at what's going on, it continues to be, I think, the same theme. Stocks remain on the highs, yields remain stubbornly low, and the central banks keep their hands in the cookie jar. And until they actually remove the stimulus, until they take the positions off their balance sheet, until they get rates off zero, which is essentially where they still are, I think that volatility will remain low. It has why would it go up? It still has a safety net under it. And I think that right now the Fed is trying its best to get rid of that safety net, to get the market back on its own 2 feet. It just hasn't been able to do it yet. So what are we looking at next week? Next week is a very light economic calendar. We have very few Fed speaking because of the fact that we have FOMC coming up at the end of the month. Likewise, we have an ECB meeting. We have a Bank of Japan meeting. Those will be key. I think that Mr. Draghi is going to be looking to add to some of the momentum he had at the end of June and subsequently may have lost in Yellen's testimony this week. So I think he'll be very hawkish about the economy, stronger economy, whether it's the German-led economy leading the ECB out of this recession or not. I still think there are question marks over countries like Greece and Italy. But moving forward, we have that. Likewise, we do have we have second quarter earnings. We'll get some major manufacturers. I think that's going to be key. Watching the equity markets, the bond market could be in very reactive mode, which means I think we'll probably be in a range trade unless something really goofy happens. Then we'll probably see bonds rally and we'll test those lows. So right now in the bond market, showing signs of yields trading back lower to where they were a few weeks ago, but we're unable to hold. We'll have to wait and see what happens next week. This is Todd Colvin coming to you from the floor of the CME Group.